get your head around the art of technical analysis. You know how crucial it is to spot those moments, those times when a really dominant trend starts to look a little shaky. Today, we are strapping in for a deep dive into one of the most, I think, powerful visual signals in all of charting, the inverted hammer candlestick.
Yeah.
Our mission here is to take all this research we've gathered and really distill it down. We want to get to the essence, the structure, the location, and the market fight behind it.
Exactly.
So you can really understand its predictive power, not just, memorize another shape on a chart.
Right, because just memorizing the shape it's almost useless.
Yeah.
Technical analysis is only useful when you understand the story behind the lines. If you see an inverted hammer and you don't instantly translate that into a narrative of, say, buyer failure, you're missing the whole point.
So it's a statement.
It's a very distinct visual statement about the market's inability to keep pushing up.
Okay, let's unpack that dramatic statement then, starting with the very basics, the anatomy. Visually, what should we be laser focused on here? How do we tell a real inverted hammer from something that's just, close?
Precision is everything. It really is. We need 3 or 4 key components to be there. First up, the body. The body of the inverted hammer is, well, it's extremely small. That's its defining feature. It shows a really minimal range between where the price opened and where it closed.
And what makes it so small technically?
It comes down to the relationship between the low and the close. The sources are super specific on this. The low of the candle has to be equal to or almost equal to the closing price.
Almost equal. How close are we talking?
We're talking a tiny difference, maybe 2 to 4 points, max. It's not some arbitrary number. It's psychologically important. It shows that by the time that period ended, the price was shoved right back down to its lowest point.
So any attempt by the buyers to hold a higher price just completely failed.
Exactly. It shows zero persistence from the bulls.
Right.
Now, the wicks. The contrast between the wicks it's critical. The upper wick is very, very long. That's the inverted part, the whole drama of the pattern.
Right.
And the lower wick. It should be, for all intents and purposes, non-existent. Or if it's there, it's just this tiny little formation.
Okay, so we've got this tiny body sitting right at the low, and then this massive, dramatic upper shadow. But how do we define massive and small? I mean, in a way that works if I'm looking at a 5-minute chart or a daily chart.
Good question. And this is where we get the sort of proportional rule. It's a really memorable detail that helps you screen out all the false positives.
A rule of thumb, I like it.
Yeah, a great rule of thumb. So if you imagine the entire range of the candle from the very tip of that long upper wick down to the absolute low.
Okay, the whole height.
The whole height. Just mentally divide that into 3 equal parts.
Thirds. Got it.
That small body at the bottom. It should only account for one of those parts. Just 1/3.
Which means?
The remaining 2 parts, the full 2/3 of the candle's entire height, that has to be the upper wick.
The 2/3 rule. That is a fantastic visualization. It guarantees you're looking at a genuine, powerful rejection, not just some candle with a kind of long wick.
Precisely. If that wick is only, say, half the size, the story of rejection is just weaker. It's not as clear. When it's 2/3 or more, though, it's a loud, clear signal. It says whatever happened, that high price was decisively rejected.
That sets the stage beautifully. So we know what it looks like. But as you said, knowing the shape is only half the battle. So now we have to talk about context. Where does this pattern need to show up on the chart to go from being just interesting data to an actual actionable signal?
This is the rule of relevance, really. It's location, location, location. The inverted hammer is significant almost exclusively when it appears after an established upside momentum. You need a clear, sustained uptrend leading into it.
Why is that preceding uptrend so critical? What if we see it after a big drop? Does it mean anything then?
If you see this shape after a major downtrend, it actually has a different name and a totally different meaning.
Oh.
Yeah. It's called a hammer, and it signals a potential reversal up. But for our inverted hammer to be a bearish signal, it has to show up when the buyers are already supposed to be in control but are getting tired. The sources all stress this. Its importance, its relevance is highest when it forms right at the top of the price movement.
At the peak.
At the peak. If it forms halfway through a rally, it's probably just noise. But when it forms after a long run-up, maybe at a new high, it just screams market exhaustion.
So Okay, we've climbed the mountain. We see this pattern right at the summit. What is it telling us about what's coming next?
It's indicating the possibility of a coming downside momentum, or at the very least, a significant pullback, a correction.
So break or a full reversal?
It could be either. It suggests that the market has either hit a severe temporary break in the uptrend, or that the whole thing might be over, that we're about to see a complete change into a new downtrend.
It's the market basically asking, are the big players finally cashing out?
Exactly that. Or is new selling pressure coming into the game?
Which makes me want to dive right into the fight itself, mechanics of how this thing forms. That long upper wick is the scar tissue from a battle. So let's walk through it. We're in an uptrend. Buyers are in charge. Who makes the first move?
The buyers always start it. They have to, because we're still in that prevailing uptrend. They look at the current price and they think, we can go higher. So they push the price up aggressively. And that's what creates that high point, the tip of that long upper wick. They're trying to extend the run.
So the pattern actually starts with this big surge of optimism from the buyers. They are, as we said, swinging for the fences.
Yeah, absolutely. They're all in. But here's where the whole story flips. And the sources give us this really crucial insight into market pressure. At that specific high price, that strike price, the sellers just flood the market.
It's not a gradual thing.
Not at all. The information we have says the selling quantity is higher, and critically, the seller's pressure is higher than whatever buying is left at that moment. This could be profit-taking, it could be new shorts entering, but the effect is just overwhelming force. They actively reject that high price.
They aren't just selling into the rally, they're actively driving the price down.
Immediately and forcefully, yes. This is what creates that sharp downward push. It overcomes that initial bullish surge, and that's what draws that long, dramatic upper wick on the chart.
The buyers tried, they failed, and the sellers shoved the price all the way back down.
All the way back down to where the candle basically started trading.
And since it closes near its open or its low, giving us that tiny little body, it's a visual confirmation that despite that huge upward effort, sellers won the day. The buyers' initiative was just nullified.
It's a visual record of a failed attempt to go higher. That price couldn't be maintained for even a moment.
So now we get to the practical side of this for you, the listener. A signal is just a warning, right? We need confirmation before we act on it. We've seen this, this clear defeat. But how do we confirm it signals a real sustained move down and not just a one-off volatile day?
Confirmation is, I would argue, the most vital step. This is what turns an observation into a strategy. You just cannot trade based only on seeing this shape. The source material is completely unequivocal on this. The signal is confirmed only if the very next candle,
The one right after it.
the one that opens immediately after the inverted hammer, breaks the low of that inverted hammer pattern.
So the market has to show some follow-through. The rejection isn't enough on its own.
Not at all. The sellers have to prove they're still in control in the next period.
That makes sense.
Think of it this way. The inverted hammer shows the sellers can dominate. The confirmation candle breaking the low proves the sellers will dominate.
What if the next candle goes up?
Then the signal is invalidated. If that next candle trades back up, goes above the inverted hammer's body, then that rejection was just a temporary scare. Nothing more.
Can you just walk us through a quick example, numbers-wise?
Of course. Let's say an inverted hammer forms at a height of 105. Its little body is between 100 and 98, so its low is 98.
Go.
The next day or the next hour, whatever your time frame is, if the market opens and immediately starts trading below 98, say at 97.50, that is your confirmation.
The break of the low.
That's the break of the low. It confirms the sellers had enough power to maintain control and push the price even lower. Without that break, you sit on your hands. You wait.
That distinction is so critical for filtering out false signals. We've covered structure, location, mechanics, and confirmation. But if we zoom out, there's this one overarching lesson that our source material really emphasizes, the thing that ties it all together.
Yes. This is the so what moment. This is the ultimate takeaway that separates just recognizing patterns from actually doing successful analysis. And the rule is this. Any chart pattern, any candlestick, any indicator, including this one, it only works effectively when it's combined with an understanding of price behavior.
Price behavior. That's a term that sounds simple, but it's huge.
Right.
For our listeners, why do they have to prioritize that over just spotting the shape?
Because the shape is just the result. Price behavior is the context and the cause. You have to understand the whole ecosystem the pattern formed in.
Things like volume.
Exactly. Volume, overall volatility, how close you are to major support or resistance levels. For instance, imagine an inverted hammer that forms on really low volume. That might suggest there wasn't a lot of conviction among the sellers, even if the rejection looked dramatic.
Right, it was an easy win for them.
It was an easy win. Now contrast that with an inverted hammer that forms on extremely high, maybe record-breaking volume. That high volume suggests a massive amount of capital changed hands during that rejection. It lends huge weight to the idea of seller dominance. The shape is the same, but the price behavior makes one signal profoundly more serious.
That makes perfect sense. The pattern gets its power from the context. It's like hearing a loud bang. You need to know if it was a firecracker or something much bigger.
Perfect analogy. You have to prioritize understanding how and when the price is moving within that bigger framework. If you ignore the underlying price behavior, if you just hunt for the pretty inverted hammer shape, you are trading on half a story, you're just relying on hope.
And hope is not a strategy.
Not a good one anyway.
So let's synthesize this. If we pull it all together, there are really three core facts for you to take away about the inverted hammer. First, the structure. We're looking for that tiny body where the low equals the close and a huge upper wick that takes up at least 2/3 of the total range. That's the visual rejection.
Second, location. It's a powerful bearish signal only when you find it at the top of an established sustained uptrend. It signals exhaustion.
And third, the practical rule, confirmation. You have to wait for the next candle to trade below the inverted hammer's low to confirm that the momentum shift is actually happening.
That's a truly effective summary. But let's end with a final provocative thought. Something that ties back to psychology and price behavior. Since this whole pattern relies on a sudden, overwhelming surge of seller pressure at a high price, ask yourself this. What specific real-world event, something outside the chart, might cause that?
Like an unexpected news announcement.
Exactly. Or a disappointing earnings call, a sudden policy shift from a central bank. What could make sellers gain that much overwhelming pressure so suddenly that it creates this dramatic 2/3 rejection?
By connecting the pattern on the chart to the actual drivers in the market, you start to bridge that gap. You go from just reading lines to truly understanding why the money is moving.
And that's where the real edge is.
Explore that psychology, the rapid shift from buyer euphoria to seller panic, a perfect place to leave off our deep dive. Thank you for joining us. We hope this gave you the clarity and depth you needed on the inverted hammer candlestick. Until next time, keep digging into those sources.